This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, having gone through and looked at the accounting under IFRS 16 for the lessee, we're now going to go through and look at it from the other side of the contract by looking at it from the lessor's perspective. So just to go through and make sure that you're happy with where we're looking at things from. So if we have a look at the diagram that we drew right at the very start of the chapter, we've looked at how we account for company B's rental payments when they lease the asset under a lease. So remember, 99% of the leases are going to be there now on the statement of financial position, unless they are of low value or they are of a short rental period, less than 12 months. However, if it isn't a low value, if it isn't less than 12 months, then we recognise it on the statement of financial position with a right of use asset and a lease liability. Okay. Happy with that? Remember all that? Yeah, that's good. What we're going to look at now is on that far left-hand side, isn't it? Whereby we look at company A, if you like, the supplier of the asset, who legally owns it, who is the lessor. Now, what we said right at the very start is that there has been no changes with regards to the rules from what we previously had under IAS 17. But who cares what was in IAS 17? We need to look at what is in IFRS 16, regardless of whether that is the same or whether that is different to what was in the old leases standard. So what we've got in terms of going into the notes and looking at it from a lessor's perspective, we need to look at it from a finance lease and an operating lease perspective. Now, for those of you who have done previous studies using the old standard, you will be comfortable with the idea of this finance lease and this operating lease. What we have there is that the lease is a finance lease if the risks and rewards of ownership are transferred to the lessee. Okay, so when we're looking at the risk, we're looking there at the risk of the asset breaking down, the risk of the asset becoming obsolete. The rewards, we're looking there at being able to get the majority of the economic benefits from the asset's use. Now, if those rewards are transferred to the lessee, so let's just go back to our diagram there. Those rewards are transferred to the lessee. They are going from company A to company B. Okay, so the risks and rewards are moving to the lessee, company B. Okay, we as company A, the lessor, no longer have any of the risks or any of the rewards. If that's the case, then the lease that we have is a finance lease. Okay, and when we look at it as a finance lease, as the risks and rewards have gone from the lessor to the lessee, that means in substance we no longer control the asset. So we're going to have to go through and de-recognize that asset. And when we de-recognize the asset, we're going to have to show those future rental payments, so the income that we're going to receive, as a receivable. But more of that a little bit later on in the separate finance lease lessor accounting video. Okay, but the key bit is that if the risks and rewards have gone to the lessee, we de-recognize the asset and recognize a receivable. Okay. So what scenarios give rise to the transfer of the risks and rewards of ownership? Well, again, back to the notes, and what you've got there is, if we go through there and have a look at all the 5 different ones, I gather my pen. The first one there is that ownership passes at the end of the lease term. So if the end of the lease term, the lessor, okay, transfers the ownership to the lessee, then the lessee is going to have the asset for its entire life. Okay, therefore it's going to have all the rewards, it's going to get most of the risks from using the asset. So it's no longer our asset, it's no longer the lessor's asset. So we will treat it as a finance lease right from the very start. Okay. The second one there is an option to purchase the asset. So at the end of the lease period, the lessee can buy the asset at below fair value. So for less than what it is expected to be worth, and we're pretty sure that that will happen. It makes economic sense, doesn't it? If you still think you can get benefit or use from that asset and you can pay less than what it's worth, you may as well buy it, mightn't we? Okay, it's sensible from an economic perspective, isn't it? Okay, so therefore, as the lessee, you will have that asset for its entire life. So therefore, you're going to consume the reward. You're going to suffer the risk. So therefore, we will treat it as a finance lease again from the start of the lease term. Okay, so both of those, even though the ownership transfers legally at the end of the lease, we treat it as having been transferred from the start of the lease from an accounting perspective. Okay. The third one that you've got there, again, it's very subjective, and I know we're trying to get rid of subjectivity from these accounting standards, but here there's still a little bit of subjectivity in that the lease term represents the major part of the asset's life. Okay, again, the asset's economic or useful life using old dictionary terms. Again, if you're using the asset for most of its life, again, it could be 7 years out of 8, 6 years out of 8, is it 5 years out of 8? You know, that's where the judgment comes in. Then it will be a finance lease again, because you're transferring the risks and rewards of ownership to the lessee. Okay. The fourth one down is the one that we'll see in a moment in the next videos. Is that the present value of the minimum lease payment, discounting, represents substantially all the asset's fair value. So in substance, if what you are paying for the asset over the period of time, so what the lessee is paying to the lessor over the lease period, if that is essentially the value of the asset, then you are paying for the value of that asset, aren't we? And if you are paying for the value of that asset, effectively, it's because it's your asset, isn't it? Okay, so again, we will treat it as a finance lease, and from the lessor's perspective, de-recognise the asset and recognise a receivable. And then the last one there at the bottom is that the asset being leased between the lessor and the lessee is specialised in nature. If it's specialised in nature, that means that only the lessee can use the asset due to its specialised nature, and therefore the lessee will have the risks, the lessee will have the rewards. And if those risks and rewards are transferred to the lessee, then yes, you're right, it is a finance lease, isn't it? Okay, excellent. There we go. So you need to be on the lookout for those scenarios in any narrative style question. If it's computational, you'll be told that it is a finance lease, but in a narrative style question, you're going to have to go through and identify any of those scenarios or a combination of those scenarios. Begs the question, doesn't it? What's an operating lease? Okay. Are the criteria for an operating lease similar to what we have there with regards to the finance lease? The answer, quite simply, is no. Okay, there's no criteria. There's only two types of lease: finance lease and an operating lease. Okay, from a lessor accounting perspective. So if we decide that it's not a finance lease, it has to be an operating lease, doesn't it? There's no choice. It's not as if there's a third type of lease or a fourth type of lease. Two leases. If it's a finance lease, treat it as a finance lease for lessor accounting. If it isn't a finance lease, it has to be an operating lease. So there, as it says, an operating lease is any other lease other than a financing lease. So effectively what we have there is that the risks and rewards have not been transferred to the lessee. The risks and rewards remain with the lessor. So from an accounting perspective, if you have the risks and rewards, you still control that asset. So you continue to recognize the asset in your books and continue to depreciate it. The money that you receive is going to be rental income, and we will just expense that straight line over the life of the lease. Okay, there we go. Any questions? Throw them out there on the Ask the Tutor forum. If not, that's the end of this introduction. We'll go through and have a look in the next videos at examples of an operating lease for lessor accounting and a finance lease for lessor accounting